In this session, we're going to look at the process of underwriting, which, as you may be aware, is the process whereby an insurance company will assess the risk of an applicant to determine whether they're willing to issue the policy that's being applied for. So, what is underwriting? Well, as I said, simply it's the insurance company's ability to assess the risk that they would be accepting if they offered this individual insurance on their life. So the underwriter is the individual who actually does the assessing of the risk, and an actuary is the individual or the career whereby their job is to actually price that risk, to come up with the rate. So your underwriter determines whether the company is willing to accept the risk. The actuary will price the risk. Each company has and publishes its underwriting requirements to the agents, so they know exactly what information is going to be required in order for the company to complete a full underwriting. Now, these underwriting requirements are usually based on the applicant's or the to-be insured's age, their gender, and the amount of insurance that they are applying for. Usually, the older the applicant is and the larger the amount of insurance, there are going to be more underwriting requirements, more medical information and other information that is going to be required. But it's not a secret. So the agents and the advisors and the client would also know exactly when they're applying for an insurance policy, what kinds of information is going to be required, what are they going to be asked to provide. Now, the entire process begins once the completed application and the underwriting requirements are received by the company. Each company, in addition to these external underwriting requirements, have got their own internal underwriting guidelines. So they provide these guidelines to the underwriter to make sure that the whole process that is being followed by the company is consistent. So the different underwriters looking at different types of policy applications actually have a same approach to the risk assessment to ensure there's consistency, as I said, in that process. Now, underwriting, everyone thinks it's primarily medical underwriting, which it probably is, but that's not all that the underwriters look at. They will look at financial information on the applicant and the life to be insured. In addition to that, they're going to look at general lifestyle information, hobbies, habits, things of that sort. So it's not only medical, it's all three of these areas that are reviewed in terms of assessing the risk. What's the role of the agent in this underwriting process? Now, if you're the advisor, the agent, you have done your preliminary work with the client, you've got to know the client, you've gathered the information, you've determined the risks that they are facing, and you have got to the point where the client's decided to go ahead with the purchase of an insurance policy. So now your role is really to help collect that information that is required by the insurance company. That is the information, not only the information on the application, but all the other underwriting requirements that they need. And you assist the client in completing the detailed application and any of the additional forms that are required. You have to make sure the client understands that that information needs to be accurate and complete. And you should actually make sure the client understands the consequences of not providing incomplete or false information. Not doing that obviously may jeopardize the underwriting process, or even if in fact the policy is approved and later on they find that the information was incomplete or false, there are other implications there under the incontestability clause or the fraudulent clause. So clients have to be careful and be aware that they must be truthful and honest in the information provided in the application. As an agent, you have to confirm the client's identity, and usually most provinces and most companies will require 2 pieces of government issued documentation, passports, driver's license, something like that. There is the approved list varies by province. As the agent, you will also witness the signatures on the application, and then once that's all done, you submit all the requirements to the company. The company then underwrites the policy, and once it's been approved and issued, they will send that policy back to you, and you should deliver it in person to the client. When you deliver it in person, you have to confirm with the client that their insurability has not changed since you collected that information. So, their health hasn't changed, maybe their financial situation hasn't changed. So you need to confirm that there's been no change in their medical situation since you collected the information. And then you will get the agent will get the policy owner to sign and date a delivery receipt. In other words, you have delivered the policy to them and they've signed the form to say they have accepted the policy. So this is in general the role of the agent in the underwriting process. So let's talk a bit more about, first of all, we're talking here about individual insurance. We'll touch on what's required for group insurance later in this presentation. But let's look at individual insurance and some of the sources or some of the additional information that underwriters can access to help them in their assessment. So each company, as I said, has their underwriting guidelines. What point in time do we need to get the client to do a medical? They have non-medical questionnaires, so the client and the agent would fill out a questionnaire. It has a bunch of medical questions, and it's kind of funny. We call that a non-medical questionnaire, but very simply, it's a questionnaire that takes the place of you having to take a medical. So, and again, it depends on how much insurance you're applying for and your age. So, we have these underwriting requirements, medical information, financial information, lifestyle information. So all that is provided, but there are some additional sources of information that the underwriter can access if they find something in the application that causes them to question something. They may need some additional information. And so, there are a number of these other sources of information that you should be familiar with. And you should also know what kinds of information comes from these different sources. So let's start with the first one, an attending physician statement, an APS in the short form. And so the underwriter may request an APS if they found some medical issue in the application. And attending physician really means the insured, the applicants or on whose life the policy is, they want some more information on that person's medical advisor or doctor. So usually what happens is the underwriter will send a form to the client's doctor and ask them to fill out that form. They want some additional information. And usually when the applicant signs the application, part of that they agree to and they sign it is they agree that if the insurance company wants to contact their attending physician, they have the ability and the right to do that. And they've been given consent from the life to be insured to get that additional information. So the underwriter sends this form to the doctor completes that and sends it back directly to the underwriter. The doctor is usually paid by the insurance company to complete that form. So that's an attending physician statement. Medical exam, there may be in the process, maybe again, as I say, if something has been uncovered in the underwriting process, or if the face amount is quite high, or if the person is older, the underwriter may require a medical exam. So they want the applicant or the life to be insured to go and visit a medical practitioner. Usually it is an independent health practitioner that the insurance company will identify and say to the individual that you need to go and get this medical exam from our independent health practitioner. So the difference here is if they want a full medical exam, they won't go to your attending physician. They're going to go to an independent provider. Another source of information is the Medical Information Bureau, the MIB. And the MIB is a central database of medical information that you might have placed on any other applications for insurance you have done previously. So if you had applied for an insurance policy a year or 2 or 3 or whatever previously, that information on that application is actually stored at a central database. And when you apply for insurance today, your underwriter can actually access the information you have placed on your previous life insurance application to be able to review this. So they can access that information because it is shared. And so, you may have a few years ago applied for insurance with ABC company, but now you're applying for more insurance with XYZ company. And so your XYZ company can actually go into the MIB, the Medical Information Bureau, and they can gather and take a look at the information, that the medical information that you submitted in your previous application. And once again, signing the application gives the insurer the approval to access the MIB, so Medical Information Bureau. They can also access the Motor Vehicle Record, the MVR. And the MVR is really keeps track of your driving record. So the life, again, to be insured, their driving record over the past 3 to 10 years. So now you might say, well, what does my driving record have to do with my medical health? And so again, statistics have demonstrated if you've got a poor or dangerous driving record, there is an indication that you tend to have a more risky lifestyle, and in fact that may impact your insurability. And so this is another source of information, the MVR. Inspection report. An inspection report is an outside firm that the insurance company will hire. And what they're going to do is they want to gather some additional information, not medical information, but non-medical information on your habits, your hobbies, could be your financial records. So it's more about lifestyle and your financial situation than your medical situation. And so this outside firm will usually complete that inquiry either by giving you a call, or they may visit you personally, or they may gather information from outside sources. So again, if the company is going to do an inspection report on you, again, you are going to know this. It's not going to be a surprise. It's not something they're going to do behind the scenes. It would be part of the requirements that they have identified in their underwriting requirements, or if it comes up later on through the process, they will notify you and say, hey, based on our underwriting, we will now require an inspection report. And so these things are not surprises. But anyhow, so those are some of the additional sources that companies can get additional information in the underwriting process. Let's talk a bit about financial underwriting. So financial underwriting, what they also look at is the amount of insurance that is being applied for, is it reasonable? What is the basis for this? Do they really need that amount of insurance? What is the purpose of it? Is it for income replacement? Is it for estate preservation or covering tax liabilities, things of that sort? So insurance companies want to make sure the amount is consistent with the need of the client. So if you are, applying for $7 million of insurance, but you're worth $223, they're probably going to question that amount of insurance. In addition to that, part of the financial underwriting process is, can the policyholder afford the premium? And they're interested in this because if the policy is sold and it's very expensive and eventually something comes up and the client can't afford it any longer, the policy may lapse or be surrendered, and this can be an expensive process for the insurance company. They want to make sure that the policy premium is affordable. Lifestyle underwriting, as we said, lifestyle underwriting is about hobbies, activities, lifestyle types of things, drug use, drinking habits, these kinds of things. So not only, again, it's not only limited to your hobbies and activities, but sometimes depending if you're a frequent traveler, if your lifestyle is such as that you're traveling in a plane, you're visiting lots of countries, it may be part of your job, or maybe you just love to travel. This is something they're going to look at. How often are you traveling? Where are you going? How long are you staying? These kinds of other lifestyle, information are all types of things that fall under the lifestyle underwriting. So that should give you a good understanding of those three topics: medical, financial, and lifestyle. Now, what happens if you are not a Canadian citizen? If you're a Canadian citizen, not an issue. You can apply for insurance. However, if you're not a Canadian citizen, there are some concerns, or I guess there's some situations here where you may not be able to apply and get life insurance. Now, if you're a permanent resident, usually that's not an issue. So you haven't become a citizen yet, you're a permanent resident, you tend to be eligible for the same coverage as a citizen. You need to confirm, obviously, that you are a permanent resident. And in some situations, if you have been in Canada for less than 1 year, they may need additional medical information, maybe some additional blood work or medical exam, etc. But for the most part, permanent residents are treated the same as citizens. If you are now awaiting permanent residency, so you are a landed immigrant, but you have not received your permanent residency as yet, it depends on the insurance company. Some insurance companies will issue a policy, approve, they'll look at your situation. Others may or may not, depending on their practices. International students, if you're visiting here on a study visa, you're usually not eligible to receive or to purchase life insurance. I mean, if you are a permanent resident and you are now applying, to get to school, you may be treated under this basis. But international students in general, you usually cannot buy life insurance. Now, let's talk about risk classifications. As you obviously understand, not everybody is as healthy as the next person. And so when we underwriters go through the underwriting process, based on they have sort of a point system based on your medical, your financial, and your lifestyle situation. And based on the number of points that you have built up, they'll look at their charts and they can determine, what kind of a risk you are. Now, there are 3 or 4 risk classifications. The most prevalent is standard. You're a standard risk, you're a normal risk, you're an average person, and in fact, once you're accepted, your life insurance premium is going to be at standard rates. So, the majority of us, probably 70% of the population, is probably in the standard category, in that range. There are some of us who are actually in the preferred category. We're exceptionally healthy. We're a much lower risk. Maybe we are an Olympic athlete, and so we're better than the average guy. And so if we're better than the average, we may actually be charged less for our insurance. Having said that, I may be the opposite. I may be substandard. In other words, I am not as healthy as the average. Maybe I have a medical condition. Maybe I'm diabetic. Maybe I've had a heart attack a while ago. Maybe I have some other health issue that in fact leads them to believe I will have a shortened life expectancy. And so that group of people are deemed to be rated or substandard. Now, this doesn't mean they can't get insurance. They can get insurance. However, it's going to cost them a bit more. And so usually when you're rated, it's usually a percent. So if you have been rated at 150%, it means that your premium is going to be 150% of the standard rate. So if the standard rate was $10 per thousand and you are rated 150%, you're going to be charged 150% of $10, which is $15 per thousand. So if you're substandard, you have health issue, it could be that you're overweight, and so the rating is going to be directly related to your health situation. So you might be rated 125% or 150%, 200%. So depends on the rating the underwriter comes up with. Now, there are some situations where, they'll issue the policy, but if you die under certain situations, you're not going to be covered. You're going to be exclusion. There are going to be some exclusions. So you're covered except if death occurs under certain circumstances. And most likely, these tend to be those situations where you have a hobby that may be deemed to be risky. You like jumping out of airplanes. You're a race car driver on the weekend. Maybe you're a mountain climber. So there may be certain hobbies or certain situations. For example, I mentioned out-of-country travel. Maybe you're traveling to a country that has got a lot of political unrest, and it's dangerous for visitors to be there. And unfortunately, your job takes you there, quite often. And so the insurance company might be saying, we're willing to insure you, but not if you die in that country. So, there are a whole bunch of situations where they may issue an exclusion. And so these exclusions will obviously impact your coverage. Now, the last risk categorization or classification is declined. So they have assessed your risk and determined it not to be an acceptable risk. So you are uninsurable with that company. So declined and uninsurable means the same thing. Now, by the way, they might say to you that this declining is a temporary one. In other words, they may say, given your situation, if you're still alive in the next 2 or 3 or 4 years, or maybe if you, let's say you were overweight significantly and you've lost some weight, they may say to you, if in 2 or 3 years you have lost weight, as in my example, you can come back and apply again, and we'll take a look at your situation one more time. So declined again means you are not an acceptable risk to that company. Now, because different companies have different underwriting standards and requirements, it may be that you might be declined at one company, but maybe you might be rated or deemed to be substandard at another company. And so usually once someone has been declined at one company, the agent will probably submit the application maybe to 1 or 2 other companies for them to take a look at it and for them to determine, do they feel the same way? Are you uninsurable, or maybe they would be willing to accept you on a rated basis. And so again, because these standards are all company specific, we have the opportunity to go to other companies to see what they think. Okay, so let us now move on to some of the factors that are going to impact how much you're being charged. So, you may recall a discussion that, premiums for life insurance are based on 3 factors: the mortality costs, the admin expenses that a company has, and investment returns. And so these really are company factors that will affect the premiums that the company charges. So their view of mortality costs, what their current admin expenses are, and their investment returns. So those are going to obviously impact how much you are going to be charged. But there are also some factors, client factors, that are going to affect how much you're charged. And so, obviously the premium is going to be related to your age, your gender, your health or risk classification, hazardous occupation or lifestyle factors. Again, they may be an exclusion here or not. So, our risk classification and the premiums we pay are impacted by these client factors and company factors also. So make sure you are aware of these different factors in how insurance companies set their premium. Okay, now another point I want to cover is the topic of reinsurance. And so you may have seen this term. What is reinsurance? Well, if I'm an insurance company, I am basically a conservative organization. My job is to manage risk, and usually what I have to be careful of is that I don't have one individual who has a huge insurance policy, and that one individual dies and I have a claim for $5 or $10 million of insurance on that person's life, which can be a significant cost, significant hit to my bottom line. And so insurers want to make sure that, in situations where we have high risks per individual, that they are only willing to retain the risk up to a certain amount. So this is referred to as their retention limit. So they're willing only to retain life insurance, the risk up to X number of dollars per individual. So if, for example, you wanted $5 million of insurance and the insurance company approved that, they say, yes, you qualify for the $5 million, and they're willing to issue that policy for $5 million, and that's great. You get the policy. You, in fact, pay the premiums to that insurance company, and that's it. You have no idea behind the scenes that the insurance company has utilized a reinsurance company. So what that insurance company would do, if their retention limit is $2 million, they would go to other insurance companies and say to them, we have this policy for $5 million. We are retaining $2 million of the risk. We would like to reinsure the additional $3 million. And so they might go to 3 other companies, and each company might say, okay, we're willing to take $1 million of that risk, and the other 2 million. So in fact, they may share the additional $3 million risk with those other companies. And they will pay part of the premium that you're paying to those other companies to cover that risk. So reinsurance companies will, pass on this excess risk to another reinsurance company. And so, again, from your perspective, it's behind the scenes. All you know and all you care about is that you've got $5 million of insurance with this, company XYZ, and you're paying your premium, and you're guaranteed that if you die, the entire $5 million is going to be paid because you have a policy stating that. All that the insurer has done is they have covered themselves in the event they have this huge claim coming in. So that's what we mean by reinsurance. Now, those are the points I want to make with respect to underwriting individual life insurance. We have a couple of other things I want to cover, and that is in the group area. And so underwriting group life, as you know, group plans are very different than individual plans. And so if I'm going to look at group life underwriting, it's quite different. As you know, group insurance, all members are covered for a basic amount, regardless of your health. Under the group insurance topic, that's under a separate video. You'll learn all about group life insurance. But, fundamentally, group life insurance, every underwriting is actually done at the group level. So they look at the entire characteristics and risk profile of the entire group. They don't look at individual members of the group. They look at the entire group, and they make an assessment about the risk profile of that group. Now, obviously, if you are recent graduates from a university, and you're in your 20s, that group of people is going to have a different risk profile than if I'm looking at a group of lawyers or a group of chartered accountants, or a group of medical doctors, so whatever. So again, when we're looking at these groups, the group characteristics and the risk profile of the group are going to impact how much the insurance company is going to set as the premium. So it's sort of an average risk per person approach to calculate the premium there. So again, underwriting of group life insurance, there isn't individual underwriting taking place. Now, there is a situation whereby under some group plans, you may have the ability to buy more than the basic amount available under the group plan. So in other words, they say, maybe, for example, you can buy 1 times your salary up to 2 times your salary without providing any medical information. However, if you wanted to buy more than 2 times your salary, maybe you want 3 or 4 times your salary, then they would allow you, some group plans allow you to buy more than that basic amount, but you're going to have to provide evidence of insurability. So there is that option available under group life plans. Now, the other type of group plan I want to talk about is creditor life insurance. Now, as you know, your creditor is someone that you have borrowed money from, and so you actually can buy insurance to cover an outstanding balance of a debt that you may have to a creditor. So it is a creditor life insurance, or creditor group life insurance is a type of group insurance. Now, in this type of coverage, you must provide some basic evidence of insurability. So they will have a health questionnaire, and it's fairly general. You may have 5 or 6 general questions about your health, and as long as you answer no to all these questions, then they'll go ahead and issue the policy. If you answer yes to any of the questions, they may say you're not eligible, or they may say, aha, there's a yes answer here. We're going to want some medical information on you. So again, different than group life, because they are actually asking you for some medical information. Now, the premium you're going to pay for creditor life insurance is usually a fixed monthly rate per 1,000 of the outstanding balance that you owe. So if it's a credit card balance, they're going to charge you, X dollars per 1,000 for the outstanding balance that month. If it is a mortgage, for example, then it's usually going to be X number of dollars per 1,000, but it's usually of the original mortgage. So, they'll charge you the same amount per 1,000 of original, even though your balance might be less. They need to recognize the fact that you are also each year getting older, and so by charging you a level premium, they're taking into account the fact that you're older, but the amount outstanding is declined. So, one of the key issues and challenges we have on creditor life insurance is that because they just ask a few health questions up front, usually there is more significant post-claim underwriting. So at the time of a claim, you could find that the claims examiner, they're going to ask for potentially a lot more information than simply, here's the death certificate. They're going to do probably more investigation to make sure that there was, they might find, in fact, that you actually didn't qualify for the insurance at the beginning. Now, this is a very, obviously, not very acceptable to the deceased and the deceased estate, because all the way along they thought they had coverage. They answered these questions correctly, but through the post-claim underwriting at the time of a claim, something might have been uncovered. So not ideal, obviously, but this is the way this operates. Again, because you get it with very basic evidence of insurability, you might find that the claims process tends to be a bit more challenging or more detailed. So that's the all that I want to talk about now on creditor group life insurance. So we have in this session covered in underwriting for individual life insurance, for group life insurance, and for creditor life insurance.